Something major is shifting beneath the global markets. Not in a dramatic headline, not in a breaking news alert, but in the small, quiet signals that appear long before most people realize change is coming. A similar shift appeared before some of the biggest fortunes were made, in 1929 and 2008. Are you noticing the early signs? Or will you see them only when everyone else is already panicking? Let's break down the 3 warnings the smartest investors watch, and the one stage where wealth is historically built. Warning 1. Smart money moves first. The first warning sign of market stress is never dramatic. It's not a crash, it's not a crisis, it's a shift in behavior. Sophisticated investors rarely wait for the storm to hit. They move early, sometimes months or years before the public catches on. Not because they know the exact timeline, but because they recognize when conditions begin moving in the wrong direction. In past cycles, this early behavior looked like pulling back when leverage increased, avoiding sectors with unrealistic valuations, reducing exposure when fundamentals weakened, taking profits while optimism was still high. Not every professional investor got it right. Many didn't. But those who did often shared one common trait. They acted before risk became obvious. And today, analysts are seeing behaviors that echo those early movements. Rising insider selling across multiple sectors, higher corporate executive diversification, large funds increasing liquidity, portfolio managers rebalancing for downside scenarios. These actions aren't predictions, they're precautions. Smart money isn't betting on disaster, they're preparing for uncertainty. And preparation is only the first stage, because after caution comes something even more revealing. Warning 2. Quiet hedging begins. Here's where the tone shifts. Not loud, not panicked, but measured. Everyday investors buy with hope. Experienced investors buy with insurance. Before many past downturns, whether in the early 2000s, during the financial crisis, or even before the COVID shock, professional funds increased their hedges quietly. These hedges weren't predictions of catastrophe. They were risk management, taken when insurance was cheap and sentiment was calm. Today, similar hedging behavior is emerging. Put-call ratios increasing, signaling more protective positioning. Higher demand for volatility hedges, rising interest in credit protection on vulnerable sectors. Funds allocating a portion of their portfolios to defensive assets. None of these indicators guarantee a crash. But together, they suggest something important. The people who manage billions aren't waiting for certainty. They're preparing for scenarios. And after hedging comes targeting. Because markets don't crack everywhere at once. Pressure always starts in the weak spots. Warning 3. Stress concentrates in vulnerable sectors. This is where the historical parallels become most valuable. Major market downturns have never begun as system-wide collapses. They start in the sectors already under strain. In past eras, in the 1920s, it began with highly leveraged investment trusts. In the 1970s, companies dependent on cheap energy were hit first. In 2000, unprofitable dot-com startups collapsed long before the rest. In 2008, subprime lenders cracked months before the broader crisis. Every period had a weak link, and stress spread outward. Today, analysts are closely watching commercial real estate. Not because collapse is guaranteed, but because this sector is showing clear signs of pressure. Office vacancies rising in major cities. The rise of remote work reducing long-term demand. Refinancing becoming harder as interest rates remain elevated. Some property values adjusting downward. Regional banks exposed to challenging loans. This doesn't mean a crash is forming. but it does mean the system has friction points. And when financial conditions tighten, those points often respond first. If pressure expands, whether slowly or suddenly, markets can shift faster than most people expect. And that brings us to the moment that defines investor behavior more than anything else. The breaking point, when sentiment snaps. Every financial era reaches a turning point. Sometimes it takes years, sometimes months, sometimes days. But the shift is always emotional before it becomes financial. In past downturns, the catalyst wasn't just the event, it was the reaction. Fear overtook analysis. Liquidity dried up. Investors rushed to exit at the same time. Safe assets were hoarded. Volatility spiked. Even strong companies fell simply because markets moved in waves of uncertainty. This is the moment most people fear. This is where headlines erupt. This is where social media explodes with predictions. But here's the surprising truth. The most successful investors don't end here. They begin their most profitable stage here. Because what comes next is where long-term wealth is historically created. The final stage, strategic accumulation during fear. This is what separates market survivors from the investors who build generational gains. Throughout history, many of the best opportunities appeared during periods of maximum pessimism. Not because people timed the bottom perfectly, but because values fell far below fundamentals. Investors who had patience, discipline, cash reserves, and a plan were able to acquire quality assets at major discounts. Nothing about this requires predicting a crash. It requires preparing for volatility. And preparation is exactly what some institutions are doing. Holding larger than average cash buffers, raising capital for stressed asset opportunities, watching for mispricing in sectors under pressure, waiting for sentiment to overshoot to the downside. The goal isn't timing, the goal is readiness. History shows that after periods of fear, whether in the 1930s, the 1970s, 2000, 2008, or 2020, confidence eventually returns. And when it does, those who positioned early, without panic, without emotion, often came out far ahead. The takeaway: history doesn't repeat, but risk behavior does. Financial cycles don't copy each other, but human behavior echoes across generations. Optimism, complacency, caution, hedging, fear, opportunity. These stages repeat not because the world stays the same, but because people do. The real question isn't whether a crash is coming. No one knows that. The real question is, are you preparing like the people who panic? Or like the investors who stay disciplined, informed, and ready for whatever comes next? Share your thoughts below. And if this breakdown brought clarity in a confusing market, be sure to like and subscribe for more deep dives like this. We've also added credible sources and data references in the YouTube description so you can verify details yourself.